Hello everyone, this is Dr. Zaidi. Welcome to my YouTube channel ZTube. In this video, I'll be discussing an example of master budgeting. So we'll start with the sales budget now. Here is the example. Z Corporation manufactures coffee mugs. The company is expecting to sell 100,000 mugs for $10 each during the first quarter. So the total of 100,000, right? Z is preparing the quarterly budget. Further details are provided below. So this is the number of units budgeted to be sold during the next 5 months, January through May. All right. So prepare a sales budget. So because we are preparing a quarterly sales budget, we need to account for the first quarters. We are preparing a quarterly budget for the first quarter. So we are going to use January, February, March, the 3 months for the first quarter, and then the total column on column E. Okay. And then in addition, we have April, May. We are going to use this information in the upcoming budget. So I added April and May here. We're not going to need this for this particular section for preparing the sales budget. However, we're going to need it for the future section. So you can prepare that. If the additional information is given, you can prepare it on the side, if not together. So here, the sales budget consists of two things: the selling price and the quantity to be sold, right? So selling price is given $10 each. And then the quantity to be sold is provided in the table here, which says that 50,000 January, 30,000 in February, and 20,000 in March. So 50, 30, 20, total of 100,000 in the first quarter. So in order to calculate the sales, the total sales is the selling price times the quantity sold, right? So we multiplied 10 times 50,000, 500,000, and 300,000 for February, and 200,000 for March. And then we added total. So if you see here on the horizontal column, we added all the units needed to be sold in the first quarter, which is 100,000, 50, 30, and 20 is 100. And times $10 per unit is 1 million. All right. You can also add horizontally 500 plus 300 plus 200 is 1 million. So that's the quarterly sale, right? So you are planning to sell 1 million during the $1 million sales during the first quarter. April, May, as I said earlier, will be used to prepare the next budget. We'll continue our example, and now we're going to prepare cash collection schedule, all right, or cash collection budget. So cash collection schedule comes from your sales budget first, because a lot of times, and for most of the companies, the sales is on credit, right? It's pretty much impossible in today's world that you are only doing a cash sales. So because every company uses credit sales, so there must be some collection patterns, whether they collect sales in the month of sales or in the following month or 2 months following. So we prepare cash collection schedule for that. So in this example, Z Corporation sells on account. Z collects 50% of sales in the month of sales and 40% in the month following the sale. So 50% of the sales is collected in the month of sale. So if you have made $100,000 sales, you will collect 50,000 at that particular point in time, right, within that month. And then the 40% is collected in the month following the sale. So next month you will collect the 40%. However, 10% of the sales is uncollectible. So that count as a bad debt, right? You're not going to be able to collect that just because the customers default or for any other reasons. Okay. So December 31st, last year's ending balance, accounts receivable balance is 20,000. So last year ending balance becomes this year's beginning balance. December 31st ending balance becomes January 1st beginning balance. Or you can also say, because December was the last month, so this month is January, so this becomes year beginning balance for this month. So always remember, if December is the last month of the year, then it is also the last month of the quarter, of the fourth quarter, right? So when you move to the next quarter beginning balance would be what was the December's, which was the last quarter of the previous year's ending balance was, right? Last year's ending balance becomes this year's beginning balance. Last month's ending balance becomes this month's beginning balance. So in this case, in terms of December, three things are happening, right? You can consider this as a last month, December, and this month, January. So last month ending balance becomes this month's beginning balance. You can consider December as the last quarter. The last quarter's ending balance becomes this quarter, which is January, February, March, beginning balance, or the last year ended December 31st becomes this year's beginning balance. So they already have $20,000 that they are going to collect in January, right? So prepare cash collection budget. So if you look at here, we have 3 months of the quarter, January, February, March, in the first row, and then the accounts receivable balance on December 31st was $20,000 that you're going to collect 20,000. So this is all the collections you have. 20,000 you're going to collect. What else are you going to collect in January? Because you made, if you go in sales budget, says $500,000, you made $500,000 sales, or you're budgeting that you're going to make $500,000 sales in January. And your collection pattern is what? That you collect 50% of the sales in the month, right? So 50% of 500,000 will be collected in the month of sales, which is January. So 500,000 times 50%. And then 40% in the following month, 500,000 times 40% in the following month is February, will be collected in February. Okay. Now move on to the next month sale, which is February. Look at the sales budget, $300,000 sales. So from 300,000, 50% you will collect in February, which is the month of sales, and 40% following month, which is March, 120,000. And then you move on to the third month, March, which has $200,000 sales. You will collect 100,000, which is 50% of 200,000 in the month of sales, which is March, and the remaining 40% in the month following. And the following month is April, which is the next quarter. So I added an extra column here, April's column, which shows that you are going to collect 80,000 in the next quarter. That becomes the ending inventory of this quarter, ending inventory of March, not inventory, the ending accounts receivable balance. Let me correct myself, sorry. Ending accounts receivable balance for March, also ending accounts receivable balance for the first quarter becomes the beginning balance of April, or the beginning balance of the next quarter, or quarter two. $80,000 you will be collecting in April, okay? So that's accounts receivable balance for April. Now, so this month, what you have collected is 20,000, 250,000, 200, 150, 120, 100. So this quarter you collected 840,000. Or you can add vertically here, and then horizontally 270, 350, 220 is 840,000, right? So this is, in this quarter, you're going to collect $840,000. If you look at the budgeted sales for the first quarter is 1 million, and you're collecting less than that. And in $840,000, there is 20,000 from the prior year balance that you're receiving, right? So prior month or prior quarter, 20,000. So if you subtract that, you're only receiving $820,000, not 840, from the first quarter sales, which is $1 million. Okay, 80,000 you're going to collect in next quarter, but also 10% of the sales is lost because these are the bad debt expenses. So you won't be able to collect cash for the 10% of the sales. We now move on to the production budget. On December 31st, last year's ending inventory, Z Corporation had 5,000 units on hand. So again, last year's ending inventory becomes the beginning inventory of this year. Z wants the ending inventory to be equal to 10% of the following month's budgeted unit sales. So during the current period, if we are in January, we expect that, or we budget that we will keep our ending inventory at 10% of the next month's budgeted sales. So if February's budgeted sales is 100,000 units, then this month's ending inventory should be equal to 10% of 100,000, which is 10,000 units, okay? Prepare production budget showing the quantity of units to be produced. So how many units are we going to produce? Now, this is driven from sales budget. How much sales we are budgeting that we are going to have during the upcoming months, in the quarter, in the months, So if we expect that 100,000 units are going to be sold during a certain month, or during a certain quarter, or during a certain year, our production should be based on those 100,000 units that we are budgeting to be sold. Now, it doesn't just rely on the sales budget itself, because you may plan to sell 100,000 units, but you may or may not need to produce 100,000 units, because it depends on your beginning inventory, which is last year's ending inventory. If you're carrying some units from the last year's ending inventory, then you may not need to produce as many during this period. Also, if you're planning to keep extra units, just in case if demand goes up, you have some units to sell, then you may have to sell more units than you are planning to sell. You have to produce more than that. So, for example, if you are planning to sell 100,000 units in the next quarter, and you don't have any beginning inventory, but you want to keep 10,000 units extra in the ending inventory, just in case if sales go up, then you have to produce 110,000 units. But on the other hand, if you also have the beginning inventory or last year's ending inventory, and you already have 50,000 units sitting there that you haven't sold, then you may not have to produce 110,000 units. Now you subtract that 50,000 units, you are going to only produce 60,000 units, right? So your production budget depends on how many units you have in the ending inventory, and how many units you want to keep, how many units you have in the beginning inventory, and how many units you want to keep in the ending inventory. All right. So let's start with this. So if you see the production budget here, you will see the formula here is budgeted sales in units. That's driven from your sales budget, right? Plus the desired ending inventory, how many units you want to keep in the ending inventory, will give you total units or total needs. Okay, and minus beginning inventory, what you have already in the inventory, so you don't have to produce them. This will give you how many units you have to produce or required production. So if you go in January, it's 50,000, and February is 30,000, and March is 20,000 budgeted unit sales. They are coming from your sales budget. If you go back to sales budget, you will see that you have 50,000, 30,000, and 20,000 unit sales in January, February, and March respectively. Okay, so we brought this here. Now the desired ending inventory, as the question says, is ending inventory to be equal to 10% of the following month budgeted unit sales. So the desired ending inventory is 10% of the following month budgeted unit sales. So right here is 30,000. 10% of 30,000 is 3,000. All right. Then for February, 20,000 is the budgeted sales. For March, 10% of the following month sale, which is March, 20,000 will be 2,000. So you get February. Similarly, you will do for March, which is going to be, because this is the quarter ends in March. So now you're going to move to April. Okay, next month is April, and the April's budgeted sales is 10,000. So we need 1,000. 10% of 10,000 is 1,000. So that's why I have extra column for April and May in my sales budget, and also in my production budget, because we are going to need this information in future budgets. We may need this May information as well, right? So we have the April sales 10,000, 10% of which is the March ending inventory 1,000. So now we're going to add these together. So January's sales budget plus the desired ending inventory of March will become 53,000 total needs. But then you have a beginning inventory, 5,000, right? The question says itself that on December 31, the corporation had 5,000 units on hand. So they already have 5,000. You don't need to produce them. So you subtract that from 53,000. So what you have to produce in January is 48,000 units. So that's the required production in units, how many coffee mugs they have to produce. Right now you come back to February, same thing, you add them together, 30 plus 2, 32, and then you have a beginning inventory 3,000. Remember, the beginning inventory of this period is the ending inventory of the last period. Just like the 5,000 units in January was coming from December's ending inventory, the 3,000 units here in February in the beginning inventory are coming from January's ending inventory, which looks right here. January has 3,000 units in the ending inventory, becomes the beginning inventory of February. Similarly, the ending inventory of February becomes the beginning inventory of March 2000. Those green fonts represent they are transferring from here. The purple transfers from here. Okay, so that completes your March. So you need to produce 48,000 units in January, 29,000 February, and 19,000 in March. Now we move to the total column because we need to make a quarterly calculation. So we have 50 plus 30 plus 20, 100,000 units. And then we have the desired ending inventory, 1,000. So if you look at that, we have not totaled 3,000 plus 2,000 plus 1,000 here. We only used $1,000 from March because the quarter ends in March. So the March ending inventory is also the quarter's ending inventory. All right, you are not going to add them together, just the March ending inventory. If it was a December and December was ending, it was the last year, it was the last month of the quarter, it is also the last month of the year. So that becomes the yearly ending inventory, right? But in this case here, we have March, so March becomes the ending inventory of the quarter. Similarly, if you look at this, the beginning inventory of the quarter is the beginning inventory of the first month of the quarter, January. We are not going to add 5, 3, and 2,000 to come up with a number total here. No, because the quarter begins in January. So the beginning inventory of the quarter is January's beginning inventory. So we are going to only take the January's inventory here. So 100 plus 101,000 total needs for the quarter minus 5,000 because we had it in beginning inventory will give us 96,000 for units for the whole quarter, right? And you can also perform the calculation for the month of April as well. Now we move on to the direct materials budget. On December 31st, Z Corporation has 10,000 pounds of materials on hand. Z uses 2 pounds of material to produce 1 coffee mug. Z purchases material at 50 cents a pound. Z wants the ending inventory to be equal to 20% of the following month's production. Prepare direct materials purchases budget showing the quantity of materials to be purchased. Now remember that the material budget is driven from production budget, just like production budget is driven from sales budget, right? Once you know how much sales you're going to make or you're projecting it, then you can start producing units. Once you know how many units do you need to produce, you can working on buy raw material for that. So the direct material budget, therefore, is driven from your materials, from your production budget. Now, the production budget says that you need 48,000 units in January. So we have a required production of 48,000 units, then 29,000 in February. So we have 29,000 from production budget, and then 19,000 in March, so 19,000. Now again, your production budget depends on how much material you need to produce 1 unit of an output, right? So we need 48,000 units. It's a required production, but how much material we need to produce each unit? If we need 10 pounds to produce 1 unit, then 10 times 48,000 pounds would be 480,000 pounds, right? In this case, we need only 2 pounds because Z uses only 2 pounds of material. So we need 2 pounds. So our production need is 96,000 pounds in January, 58,000 in February, and 38,000 in March. Again, you need to rely on 2 other things, just like your production budget. How much material are you carrying in the beginning inventory, right? Or it's coming from your last year's ending inventory. And how much do you want to keep in the ending inventory? Just in case if demand goes up, then you have extra material so you can work on it immediately and produce excess demand units, okay? So that, for that purposes, you need to have extra raw material available, which in this case, Z said that the ending inventory to be equal to 20% of the following month's production need. Okay, so the desired ending inventory is 20% of the following month's production needs. Production need for February is 58,000. So the January's desired inventory is 20% of 58,000. So if you look at the formula here, it says 0.2 times C58. C58 is the column, this one. All right, so
0.2 or 20%. Okay, and then 7,600 is the 20% of 38,000, and then 19,200 is the 20% of 96,000, which is April. And that's why we needed the extra column, because the extra, this 48,000 in April are basically coming from right here. And you need this, you need May's column here to get April's 48,000, because this 3,000 was 10% of May's budgeted sales, right? So in order to fill up this April column, you had to have the May. So once you have this 48,000, 48,000 times 2, 96,000, and then 96,000 times 20% is 19,200. So that's the desired ending inventory. Now the ending inventory for the quarter is the ending inventory of the last month of the quarter, which is March. So we copied that. So we add them together. The total needs for the January would be 96,000 plus 11,600, 107,600. We do the same thing for the other months as well, and we come up with the total needs for the whole quarter. Now the beginning inventory is provided on December 31st. Last year's ending inventory, Z Corporation had 10,000 pounds of material on hand. So last year ending inventory became the beginning inventory of this month, 10,000. So we already have, so we are going to subtract that. So now we only need 97,600 pounds of material in this month, all right, in January. All right. And then your beginning inventory for February is the ending inventory of January, just like you did production budget. Similarly, you are doing the raw material budget. The ending inventory of last month is the beginning inventory of this month. The ending inventory of February, which is 7,600, becomes the beginning inventory of March. So you subtract that and you will get 97,600 for January, 54,000 for February, and 49,600 pounds for March. So this is how much material you needed in each month. And then the ending inventory, so 211,200 total needs, is the sum of all the needs, or 192,000 minus 19,200 also give you 211,200. And if you look at this 10,000, 10,000 is not the sum of all the months. 10,000 is the beginning inventory of the quarter, which is beginning inventory of the first month of the quarter, January. So we copied that. So we subtracted that, we get 201,200. So this is materials to be purchased. Okay. We need further information, so we can make a cash disbursement budget, just like we created cash receipt budget after we prepared the sales budget. So we were receiving cash, right, for the sales we made on credit, or for the sales we made on cash. So we prepare cash receipts schedule. Similarly, when we purchase material, we pay for labor, we pay for anything, then we can also prepare cash disbursement budget. In this case, we are preparing cash disbursement budget for materials only. Okay. So each pound of material is 50 cents as given in the question. So times the material to be purchased, which is 97,600. So this will give you the January's cost of material, 48,800. Similarly, we can calculate for February and we can calculate for March. The quarter's cost is 0.5 times 201,200 pounds, the total pounds for the quarter, which is $100,600. Or you can also add these sums, 48,800 plus 27,000 plus 24,800 will also give you the sum of the quarter, the quarterly spending on the raw material, or the budgeted quarterly spending on the raw material. The next is we prepare the cash disbursement schedule. So because we have to purchase material that costs 48,800 for January, 27,000 for February, and 24,800 for March, we may pay cash for all the material, or we may pay some cash and buy some materials on account. So it depends on the company's policy. So look at what Z Corporation's policy is. Z Corporation purchases on credit. December 31st, accounts payable balance is $10,000. Z's pay Z pays 60% of the amount of purchase in the month of purchase and 40% in the following month. Prepare cash disbursement schedule for the first quarter. So in this case, Z doesn't default, unlike our accounts receivable or the cash collection budget, where the customers are defaulting and 10% was uncollectible. Z Corporation pays everything that they owe. So in this case, they pay for their purchase 60% in the month of purchase and remaining 40% in the next month. Okay, so they pay everything. Their accounts payable balance is 10,000 from the last year, December 31st, or the last month or the last quarter, which will be due this month in January. So in January, they will pay, the first thing they will pay is the $10,000 that they owe from the prior period. So if you look at here, so we have January, February, and March columns here. The accounts payable balance December 31st was 10,000. So that would be the first thing that needs to be paid. And then the first month uh, purchases are 48,800 from your production budget. So we copied here 48,800. 60% are paid in the month of purchases, which is January. 60% or 40% are paid in the month following of the purchases, which is February. So 40% of 48,800. You do the same thing for the February one. Your purchases are 27,000. So coming from your production from your materials budget, 27,000. 60% are paid in the month of purchase, which is February. 40% are the following month of purchases, which is March. From the March purchases, which are 24,800, 60% are paid in the month of March and 40% are paid in the month following, which is April, which is the next quarter, right? So if you see, we didn't put it in this quarter's budget. So we separated out. So April column shows this is the next period's beginning inventory, just like we have 10,000 in the January, which was the last year's ending inventory, became the beginning inventory. So this would be 9,920 would be the first thing that's due next month or the next quarter when we start in April. This will appear on the top that $9,920 is paid by Z Corporation. Our next budget is direct labor budget. So there is three things you need to remember. One is you need to know what is the wage rate. Second, you need to know that how long would it take to produce one unit. And third is that how many units you are producing. So these are the three things. So when you have those three things, you can find out how much is the company's direct labor cost. If it takes you 1 hour to produce one unit and you get $10 paid, then $10 times one unit will be $10 per unit, plus how many units you are producing, 100 units, so $10 times 100. So that way you can calculate the company's direct labor cost. Now, sometimes the companies have a no layoff policy, as such in this case. In when the company has no layoff policy, what happens is if the workers work below 40 hours, which is the minimum hour weekly hours, then they still get paid for 40 hours. However, if they go above 40 hours, they don't get paid time and a half, or they don't get paid overtime. So if workers are working 28 hours, 30 hours, and there is no layoff policy, they will get paid for 40 hours minimum. If they work like 45 hours and their wage rate was $10, the regular wage rate is $10, then anything above 40 hours, they will still get paid. But, so 45 minus 40, there's the 5 hours of extra time they work. They will still get paid, but they're not going to get paid time and a half as, like, for example, $15 an hour for those 5 hours. They will still get paid for like $10 an hour. Okay. So in this example, Z Corporation has no layoff policy, and each employee gets paid for at least 40 hours of work week. However, due to no layoff policy, workers are not paid overtime and are paid at the rate of $15 an hour, regardless of how number of hours they work. Each mug requires 3 minutes to produce. During the first quarter, direct labor will be paid for at least 1,400 hours per month. So remember that because our rates are given in hourly basis, and the time it takes to produce each mug is given in the minute basis, so you need to convert it with the same scale on hourly basis. So 3 minutes divided by how many minutes you have in an hour, 60. will give you 0.05 hours. If it takes 6 minutes to produce, then 6 minutes divided by 60 would be 0.1 hours. So in this case, it's 0.05 hours to produce. During the first quarter, direct labor will be paid for at least 1400 hours. So the total direct labor hours are 1400 for the first month. Even if they work 1200 hours, they will still get paid for 1400 hours. If they work 1600 hours, then they will get paid for 1600 hours, but not an overtime rate. Okay. So prepare the labor budget for the first quarter. So again, it's coming from your production budget. Required production is 48,000. So if you go back on production budget, you will see that the required production for your January is 48,000, February is 29,000, and 19,000 is for March. So that's coming from there in your labor budget. Okay. 48,000, 29,000, 19,000. Then each mug requires 3 minutes or 0.05 hours to produce. So 0.05 times 48,000 hours is 2,400 hours required to produce 48,000 units in January, 1,450 in February, and 1950 required in March. So that how many direct labor hours are required for the quarter? 4,800. Now, because the guaranteed labor says that during the first quarter, direct labor will be paid for 1,400 hours per month. So we entered here guaranteed labor hours 1,400, 1,400, and 1,400. Okay. Now we will pick whichever is the larger here. 24 or 1,400, 1,450 or 1,400, 950 or 1,400, because the labor is paid based on which at least 1,400 hours. But if the number of hours are more, they will get paid for more hours. If the number of hours are less, they will still get paid for 1,400 hours. So here, because they work 2,400 hours, they will get paid for 2,400 hours. Here they work for 1,450 hours, they will get 1,450 hours. But here in March, they worked only 950 hours. The minimum is 1,400 hours. So they get paid for 1,400 hours. Times $15 is the wage rate. So 36,000 labor cost for January, 21,750 for February. March is 21,000. Okay, you add them together, 78,750. Or you can do vertically, 96,000 is the total required production for the 3 months, times 0.05, 4,800. Okay, 5,250. But you will get, because 5,250 is more than 4,800, you will get paid for this $15, 78,750 for your direct labor cost for this quarter.
Our next budget is manufacturing overhead budget. Now, Z Corporation uses direct labor hours to apply manufacturing overhead to product. So direct labor hours are used. Manufacturing overhead can be driven by labor hours, can be driven by machine hours, or can be driven by anything. It depends on what is driving the cost in the manufacturing overhead department, for the manufacturing overhead. So in this case, it's driven by the direct labor hours, which can be obtained by the direct labor budget. The company applies variable manufacturing overhead at the rate of $10 per direct labor hours. So the variable manufacturing overhead rate is provided. Z's fixed manufacturing overhead cost is $40,000 a month. So fixed manufacturing overhead is provided. Now the fixed manufacturing overhead includes 10,000 of depreciation expense on machines. Okay, and I'll discuss this, why this information is provided. We need this information because this is a non-cash outlay. Prepare manufacturing overhead budget for the first quarter. Now, when we prepare manufacturing overhead budget, different firms uses different way of producing this budget. In this case, we are going to separate out the variable portion and the fixed portion of the manufacturing overhead cost, because the variable portion is driven by the budgeted direct labor hours. We are going to jump into our direct labor budget and see what our direct labor hours are. So it's driven by the actual direct labor hours, right? So here is your direct labors required: 2,400, 1,450, and 950. And in row 92 is the labor hours to be paid: 2,400, 1,450, 1,400. Now, these hours are for the direct labor payment. This is for the direct labor cost purposes, but these are not the actual direct labor hours worked, because in March, 950 direct labor hours were worked, not the 1400. Okay, so we are going to use the direct labor required row here on 90, row 90, which has 2400 for January, 1450 for February, and 950 for March. These are the actual direct labor hours worked. And when we calculate overhead, it's actually driven by the actual activity level. Actual activity levels are 2400, 1450, and 950 for January, February, and March, respectively. So that multiplied by the $10 direct variable manufacturing, sorry, not direct, the variable manufacturing overhead rate, $10. This will give you the variable manufacturing overhead cost for January, 24,000, 14,500 for February, 9,500 for March, and the total 48,000. Now we also have the fixed factory overhead, which is 40,000 is given. So we add 40,000 fixed factory overhead. So the total overhead cost or manufacturing overhead cost for January 64,000, February is 54,500, and March is 49,500. We can add them together horizontally, is 168,000 for the whole quarter, or we can do vertically here, 4,800 times 10, 48,000 plus 120 for the 3 months fixed factory overhead will give you 168,000. So that's your total manufacturing overhead cost. Now this manufacturing overhead cost is reported for cost purposes because when we prepare the balance sheet and income statement, because even if it's prepared for internal reporting purposes, we need to follow some of the rules so we can align when we compare our budgeted income statement, budgeted balance sheet with the actual balance sheet and actual income statement. They should follow same rule, which is generally accepted accounting principle follows the accrual basis of accounting. So we are going to use 168,000 for the quarterly total for direct for the total manufacturing cost, and for monthly manufacturing cost 64,000, 54,500, and 49,500. However, for cash budget, we need the cash information because this is the total manufacturing cost. Doesn't mean that all the cash has been paid for cash. So if you see in the question here, it says which includes 10,000 of depreciation expense on machine. Depreciation is a non-cash outlay. Depreciation on machine or depreciation on the office building or depreciation on anything, the equipment and building, they all are non-cash outlay. So we are going to subtract the non-cash outlay from the total manufacturing overhead cost. So for January it was 64,000, we subtracted non-cash outlay 10,000, so we got 54,000. This goes in the cash budget, right? This is the cash disbursement for manufacturing overhead cost. So this is going to enter in your cash budget. Then we have February's 44,500, and then March 39,500. So for the whole quarter is 138,000 when you sum it up, so this last row 109,000 will be used for cash budget, total manufacturing overhead cost, or row 107 will be used for your balance sheet for calculating cost. Our next budget is the ending finished goods inventory budget. The ending finished goods inventory budget relies on the information that you have calculated in the direct material budget, direct labor, and the manufacturing overhead budget. Once we have that information, we can calculate the unit cost and we can multiply with the ending inventory, which can be found on the production budget. So first we start with the direct material. So direct material cost information and the quantity per unit information is provided in the question, where it says, if you go back to direct material budget, it says that the Z Corporation, Z uses 2 pounds of material to produce 1 coffee mug. Z purchases material at 50 cents per pound. So if you come back here, that's what we are doing here. We have 2 pounds of material per unit times 50 cents per pound, $1 per unit for direct material. The labor cost is 0.05 hours times 15. Again, this is in the direct labor budget. So the hourly rate is $15 per hour, and each coffee mug requires 3 minutes to produce, or 0.05 hours. So we got this information from there. So we have 0.05 hours times 15 is 75 cents. Then we have manufacturing overhead budget.
and MOH is driven by the direct labor hours. C corporation uses direct labor hours to apply manufacturing overhead. So we come back here, we uses the same cost driver. Manufacturing overhead is driven by labor hours, so we use 0.05 labor hours. And then we have to calculate the manufacturing overhead rate. Wage rate was given, whereas the manufacturing overhead rate is not given, which is also known as predetermined overhead rate. So the way you calculate the predetermined overhead rate, you divide the total overhead cost divided by your total cost driver. In this case, the cost driver is direct labor hours. So your total manufacturing overhead cost is 168,000, which you can see in the manufacturing overhead budget right here. Total MOH cost, right? You're not going to use 130,000 because this is for cash disbursement. This is not the actual manufacturing overhead cost, right? We excluded depreciation here. Depreciation should be a part of the MOH cost. So for unit calculation purposes, so we have 168,000 divided by 4,800 units. That's coming from your direct labor, 4,800 hours. So direct labor hours are 4,800 hours, the actual or budgeted direct labor hours, right? In this case, 4,800. So we calculated 35. So 35 times 0.05 is 1.75. Add them together, this is 3.5. So the unit cost is 3.5. We multiply the unit cost by the ending inventory to calculate the ending inventory cost. So the ending finished goods inventory is 1,000 units that can be seen in your production budget. So production budget shows you right here that the ending inventory for March or ending inventory for the quarter is 1,000. So 1,000 units is your ending inventory. We have used this to calculate our finished goods inventory, or the cost of ending finished goods inventory is 3,500.
Once we finish making our product cost related budgets, direct material, direct labor, and manufacturing overhead costs, we move on to the period cost, which is your operating expenses or selling and administrative expenses budget. Now you can prepare the selling budget separately and administrative expenses budget separately. If for this illustration, I combine both selling and administrative expenses budget together. In here, the variable selling and admin expenses for Z Corporation are 0.60 per unit sold. These fixed selling and admin expenses are $50,000 per month, which includes 5,000 depreciation on office building. Prepare selling and admin expense budget for the first quarter. So we divided here your selling and admin into two parts. First is the variable, the second is the fixed cost. Now the variable expenses are driven by your quantity sold. So quantity sold can be found in your sales budget. So in January, you expected to sell 50,000 units, in February 30,000, in March 20,000. So that's coming from your sales budget. If you can see, the budgeted sales is 50, 30, and 20,000 units for January, February, and March, respectively. So we got this information from sales budget. Now the variable selling and admin expenses cost is 60 cents per unit sold. So we multiply by 60 cents. We get total variable selling and admin expenses, which is 30,000 for January, 18,000 for February, and 12,000 for March. And the total is 60,000. Then your fixed selling and admin expenses is 50,000 per month. So 50,000, 50,000, 50,000 for the 3 months, 150 total. We add the variable expenses and fixed expenses together, we get the total selling and admin expenses, 80,000 for January, 68,000 for February, and 62,000 for March, a total of which is 210,000. Now this information is used for income statement purposes because the income statement is again on accrual basis of accounting. But we need to prepare cash budget too. Now some expenses are cash expenses, the others are not. So we take out all the non-cash outlays here. So that's why the information is provided, which includes 5,000 of depreciation on office building, and depreciation is a non-cash outlay. So we subtracted 5,000 from the total selling and admin expenses, which give us 75,000 cash expenses in January, 63 in February, and 57,000 in March, the total of which is 195,000 for the whole quarter. So these are the cash expenses which will go in cash budget, which we will prepare next. For cash budget, you need to know all the cash disbursement and cash receipts, including the cash balances you have, right? So cash inflows, all kind of cash inflows, however way you can get the cash. So if you are selling something, your merchandise or your product that you're selling, you're receiving cash. That's cash inflow. Even if you're not selling your merchandise or your product that you manufacture, you're not providing service, even if you sell your machines or equipment and you receive a cash, that's also cash inflow. Cash disbursement is any kind of cash that's going out of your business. So if you are paying for labor, if you're paying for material, if you are buying machines and if you're paying dividends, so anything that you are paying and the cash is going out of your business is the cash outflow, right? So your beginning balance, whatever you're bringing from the prior period, plus cash inflow, whatever cash you get, will be your total cash available. And then minus the cash outflow, whatever you have disbursed during the period, will give you the ending cash balance for the period. So you need to remember that. Now, in our example here, it says on December 31st, Z Corporation has $29,280 cash in hand. So that's the ending cash balance of last year or last month or the last quarter, which becomes the beginning cash balance of this month, which you can also see in the cash budget here. The first thing you have in January is the beginning cash balance, 29,280. So that's where it's coming from, the ending cash balance of December. Now, the company policy is to maintain monthly cash balance of at least 25,000. So they have to maintain $25,000. Now, in this case, January balance was $29,280. So that's perfect. But if it was lower than that, then company has to take some actions. What action they could take? In the next row, 142, it says that in the event the company fails to maintain the minimum cash balance, they can now borrow additional funds. Z Corporation cost of borrowing is 12% per annum. Z borrows on the first day of the month. However, any repayment of the borrowed amount is made on the last day of the month. So if the company is a cash short, if they are unable to maintain $25,000 balance, then they can borrow the difference. So for example, assuming that at the beginning balance was not 29,280, if the beginning balance was 15,000, so they were 10,000 short, they can borrow that 10,000 so they can maintain the balance of 25,000. Okay. In January, Z Corporation will be purchasing machine for cash. The cost of machine is $100,000. In February, Z Corporation will be paying cash dividend for $50,000. So that's additional information provided. Prepare a cash budget. So cash budget information comes from all the previous budgets that we have made. So first thing is we have a beginning cash balance, but then we have a cash collection. Cash collection comes from your cash collection schedule that we prepared after we prepared the sales budget. So 270,000 is the January's cash collection. And if you go back on your cash collection budget, it will show that you are receiving 270,000 in January. So that's cash collection. 270,000 for January, 350 for February, 220 for March. So those items are coming from your cash collection budget right there. 270, 350, and 220. All right. Cash collection schedule. So we add them together, beginning cash balance plus collection, total cash collection, it will give you total cash available, which is 299,280, and minus all the cash disbursement. In a cash disbursement, you paid for material, you paid for labor, you paid for overhead, you paid for selling and admin, you paid for machine, you paid for dividend, or any other disbursement you have done is going to come here. So for material, you paid $39,280, and that's coming from your cash disbursement after you prepared your materials budget. So if you look at this disbursement schedule, cash disbursement, you will see $39,280 you paid in January, $35,720 in February, in March, $25,680. So this information is coming from your cash disbursement budget, which you can see 39,280, 35,720, 25,680. Then you have direct labor. That's coming from your direct labor budget, 36,000, 21,750, and 21,000. So you go back to direct labor, and we are assuming that direct labor is paid.
immediately. So it's 36,000, 21,750, and 21,000. And then the next information is coming from your manufacturing overhead budget. So 54,000, 44,500. This information is coming from your manufacturing overhead. 54 cash disbursement, 44,500. Remember, we are not using 64 and 54,500 from here. Instead, we are using only the cash disbursement because the depreciation was non-cash outlay, which we excluded it. So 54,000 was the cash outlay that we are including here. So we got this. Then we have a selling and admin 75,000. Again, that's also non-cash outlay. All right. So so cash outlay 75,000. We excluded non-cash outlay, which was 5,000. Otherwise, selling and admin was 80,000. So after excluding non-cash outlay of depreciation, we have 75,000 in January. So we took 75,000 here. Then Z Corporation purchased material for $100,000 in January, as the question says. In January, Z Corporation will be purchasing machine for cash. So $100,000 right here is coming from there. There is no dividend paid in this month because the dividend is paid in February. In February, 50,000 dividend is going to be paid. All right. So this, when you add them together, all the disbursement, your disbursements are $304,280, which are more than your total cash available, 299,280. So your cash excess or deficiency, which is in this case, it's a deficiency, you are $5,000 cash short, or you are projecting that you will be cash short in January by $5,000. So before you are going to get cash short, because this is a budget for future, you are already going to borrow because your budgeted data says that you will be $5,000 short. So in order to maintain $25,000 minimum cash balance, you have to borrow 30,000. First, you need to get out of this $5,000 hole, and then in addition, you need to make $25,000 cash balance. So you have to borrow 30,000. 30,000 minus 5,000, that will give you $25,000 ending cash balance. All right. If this was not negative, you may not have to borrow that much. If it was positive 5,000, then you had to borrow only 20,000. But because it's negative 5,000, you have to borrow 30,000 now. So that way you can maintain $25,000 ending cash balance when the period ends. If you have already borrowed at the beginning of the month, all the borrowing takes place, it says, at the beginning of the month. Z Corporation cost of borrowing is 12% per annum. Z borrows on the first day of the month, and the repayment of the borrowed amount is made on the last day of the month. All right. So this is good now. The ending balance of January becomes the beginning balance of February. You can see 25,000 ending balance has become the beginning balance of February, 25,000. And then your cash collections coming from your, cash receipt schedule after sales budget. And then your cash disbursements coming from your cash disbursement and other budgets that you have made, labor's budget and overhead budget. In addition, you have paid $50,000 in dividend, so that you subtract. You haven't purchased any material anymore, so nothing else can be deducted for material. So 214,000 is your total cash disbursement. Subtracted from your 375,000, you have $160,000 cash access, no deficiency anymore. You have to maintain only $25,000 balance, and this is way more than what you are required to maintain. So now you have enough money at the end of February to pay off your debt. So you will be paying off $30,000 that you originally borrowed. So this is a repayment. In addition, you will be paying interest on the borrowed fund. The interest rate was 12%. So 30,000 times 12% will give you annual interest, because this 12% was the annual interest rate. Now you have to calculate the interest for 2 months. So you're going to divide this 12%, which is annual interest, by 12 and multiplying by 2. So 30,000 times 12 times 2 divided by 12. 2, because this is 2 months. January, the whole month, because you borrowed at the first day. February, the whole month, because you pay at the end of the month. So 2 months, divide by 12, because you need to calculate interest rate on monthly basis. This is the annual interest rate. This will give you 600. So $600 you will have to pay for interest. So you take out 30,600 out of 160,030. you will get 129,430 balance, the ending cash balance for February, which will becomes the beginning cash balance for March, now 129,430. You'll do same thing, you add cash collections, give you total cash collection, you subtract all the cash disbursement. This month you didn't buy any equipment, you didn't pay any dividend, so you have $143,000 disbursement. You subtract from cash collections, you have $206,250 of cash balance. It's still a lot more than you're required to maintain, so you don't have to borrow anything, you don't have to make any repayments of loan because you already paid off. So now you have 206,250 ending cash balance. The ending cash balance of the last month of the quarter is also the ending cash balance of the whole quarter. So you can see here 206,000 is the ending cash balance of the quarter. Similarly, the beginning cash balance of the quarter is the beginning cash balance of the first month of the quarter, which was January. 29,280 is the first month of the quarter. So the beginning cash balance of the quarter is 29,280. So the ending cash balance is 206,250, which will go into balance sheet from here.
Now we have all the information for um, preparing our income statement. We have product costs, we prepared direct material, direct labor, and manufacturing overhead budgets. We also have a period cost, which is selling and administrative expenses budget. So we can use this information to prepare our income statement. Now, this is a general income statement, so I'm not going to go into detail and prepare like a detailed income statement here, just like a basic form, just so you know that where this information is coming from, our sales, cost of goods sold, and selling and admin expenses and interest expense, right? There is no tax involved here. Just we are avoiding it, just making it as less complicated as possible at this point in time. So here is the income statement, Z Corporation budget income statement for the quarter ended March 31st, 20, and whichever year is. So sales is 100,000 units. That's coming from your sales budget at $10 each. So 1 million is coming from sales budget, straight from sales budget for the quarter. So if you look at our sales budget, it's $1 million is from your sales budget. All right. Then next is we have a cost of goods sold after sales budget. So again, the number of units sold is 100,000 times 3.5. This is the unit cost that we calculated in the ending finished goods inventory budget. So right there is $3.50 was the unit product cost for in the ending finished goods inventory. So if the unit cost is $3.50, we multiply by the number of units sold, we can get $350,000 cost of goods sold, which if we can subtract from the sales, we get cost of goods, we get gross profit is 650,000. Then we have a selling and admin that's coming from your selling and administrative expenses budget, 210,000, and that's the accrual basis selling and admin expenses, total selling and admin, 210,000. We are not taking 195,000, which is cash selling and admin. This is only for our cash budget. So we take 210,000 from here. We insert it in the income statement, subtract that from the gross profit, we get operating income 440,000. Then we subtract the interest expense. We paid interest on the borrowed money, $600. That's coming from our cash budget. So for the quarter, we paid $600. We are going to subtract that. We get a net income of $439,400, right? So we are not taking into consideration tax at this point, just to keep it simple. So that completes our income statement budget. Now we are going to prepare the budgeted balance sheet. Now on December 31st, the corporation reports the following balances in its accounts. Okay, so land is 100,000, machine is 101,000, retained earning 51,030, common stock 150,000. Prepare the budgeted balance sheet. So if you look at the budgeted balance sheet here, we start with the assets and then we enter the liabilities and stockholders equity account. So the assets, we have cash, we have $206,250 cash balance that's coming from your cash budget. So if you look at the cash budget, the ending cash balance here is $206,250. So we bring this here and report it in the balance sheet, $206,250. Then we have accounts receivable, $80,000. That accounts receivable balance is coming from your cash receipts or cash collection schedule that you prepared after
your sales budget. So if you look at the cash collection schedule right here, $80,000 is your April accounts receivable balance, the amount that you haven't collected in the prior period. So $80,000 we are going to report in the balance sheet as the accounts receivable amount. Then we have material inventory that's coming from your direct material budget, 9,600, which is 50 cents per pound times the ending inventory of raw material or direct material. So if you go in the direct material budget, you will see that the ending inventory in the direct material budget for your direct material is 19,200 pounds. So you get 19,200 pounds, and then it costs 50 cents per pound for the material. So that will give us a total of 9,600, 19,200 pounds times 0.5 or 50 cents. Then we have finished goods inventory. Finished goods inventory is 3,500. That's from your ending finished goods inventory budget, which is right there, 3,500, $3.50 your per unit cost time 1,000 ending finished goods inventory. That's coming from your production budget. And the ending inventory in the production budget is 1,000. So $3,500 amount is reported in the balance sheet as the finished goods inventory. Then we have machine reported 201,000 because we have $101,000 machine ending balance listed in the balance sheet. And then we purchased $100,000 worth of machine during this period. So reported in your cash budget. You purchased it for cash. So you can see here in January, Z Corporation will be purchasing machine for cash amounted to 100,000. So we reported that here, that makes $201,000 worth of machine. The land is $100,000. That information is also provided in the question. When you add all those amounts together, we'll get $600,350 for your total assets. Now we move on to the liabilities and stockholders' equity section. Our accounts payable balance is 9,920. That is coming from your cash disbursement budget or cash disbursement schedule that you prepared after your direct material budget. Okay, so here is cash disbursement schedule. The April accounts payable balance is 9,920. These are the purchases that you made in the prior months in March and you haven't paid. So you will be paying 9,920 in April. So that's your accounts payable balance reported in the balance sheet. Okay, common stock is $150,000. That information is provided right here. Common stock is $150,000. And then the next item is your retained earning. Retained earning is your beginning balance of retained earning plus net income plus your dividends. So your beginning balance of retained earning is $51,030 plus your net income. Your net income is coming from your income statements, $439,400, and plus and minus your dividend, $50,000. The dividend is coming from right here from your cash budget, $50,000, which you can see here in the question is giving in February, Z Corporation will be paying cash dividend of $50,000. So you subtract that. So the total amount for retained earning for the current period is $440,430. And then you add these amount together, this amount to $600,350, which is the same as the total asset amount, and the balance sheet balances.
Thank you for watching my video. Please subscribe my channel for live updates and other videos.